Federal Reserve, Fed meetings. The Fed meets several times a year to set interest rates and discuss monetary policy. Decisions and statements from these meetings can cause significant market movements, especially in interest rate-sensitive sectors. The Federal Open Market Committee FOMC meetings are crucial events for the financial markets, as they involve decisions on U.S. monetary policy, particularly regarding interest rates. The outcomes of these meetings can significantly influence market sentiment, either reinforcing a bullish, which is optimistic, or bearish, which is pessimistic, outlook for the stock market. Here's how the market might react in both scenarios. FOMC meeting in a bearish sentiment. Rate hike expectations. If the market is already in a bearish mood due to concerns like slowing economic growth, high inflation, or geopolitical tensions, an FOMC decision to raise interest rates could exacerbate that sentiment. Higher interest rates increase borrowing costs for businesses and consumers, potentially slowing down economic activity. This could lead to lower corporate earnings, higher debt servicing costs, and reduced consumer spending, all of which are negative for stock prices. Hawkish tone. If the FOMC's communication is hawkish, meaning it indicates a strong commitment to fighting inflation with more rate hikes or tighter monetary policy, it could deepen the bearish sentiment. A hawkish stance may signal that the Fed prioritizes controlling inflation over supporting economic growth, which can lead to fears of a recession, causing further declines in stock prices. Negative economic outlook. If the FOMC expresses concerns about economic growth, consumer spending, or the labor market, this could reinforce bearish sentiment. Investors might worry that the economy is headed toward a downturn, prompting them to sell off stocks. FOMC meeting in a bullish sentiment. Rate cut, or dovish stance. In a bullish market environment, if the FOMC decides to cut interest rates or signals a pause in rate hikes, this could further boost investor confidence. Lower interest rates reduce borrowing costs, encourage business investments, and increase consumer spending, all of which are positive for corporate earnings and, by extension, stock prices. Supportive economic outlook. If the FOMC conveys optimism about economic growth, low unemployment, and controlled inflation, it can reinforce bullish sentiment. A positive outlook from the Fed can lead to increased investor confidence, driving stock prices higher as traders anticipate continued economic expansion and robust corporate earnings. Quantitative easing or other stimulus measures. If the FOMC announces or hints at additional stimulus measures, such as quantitative easing, buying government bonds to inject liquidity into the economy, it can create a strong bullish response in the stock market. Increased liquidity and lower yields on bonds often push investors into equities, driving up stock prices. Market reactions based on expectations meeting. Expectations versus surprises. If the FOMC meeting results align with market expectations, the reaction may be muted regardless of the sentiment. However, if the FOMC delivers a surprise, such as an unexpected rate cut or hike, or a drastic change in economic outlook, it can trigger significant market volatility in either direction. Summary. In a bearish market, a rate hike, hawkish tone, or pessimistic economic outlook from the FOMC can deepen the market's pessimism, leading to further declines in stock prices. In a bullish market, a rate cut dovish tone or positive economic outlook from the FOMC can boost investor confidence, driving stock prices higher. Investors and traders closely monitor FOMC meetings to gauge the Fed's view on the economy and adjust their strategies accordingly